Hello, my name is Andy Goodman and I'm a tax partner at BDO. I have the pleasure of chairing our On Top of Tax seminars that we host twice a year. The most recent seminar was on the 13th of April, and during this webinar we will step through those presentations that we delivered at On Top of Tax. As is always the case these days, tax is a highly topical subject, so there was no shortage of pertinent topics for us to focus on. The topics that we're covering in this webinar are the key themes and announcements from the UK budget on the 16th of March, the deductibility of interest for corporation tax purposes and the current position following the OECD's BEPS recommendations, the requirements for and the benefits of companies preparing a tax strategy, the key findings from BDO's VAT survey, and finally the potential tax impacts of a Brexit. So without further ado, I will hand you over to Howard, who is going to provide an overview of the 2016 budget announcement.
My name's Howard Veers and I'm a director in the Corporate International Group in London. And I'm going to talk about some of the key business tax changes announced in this year's budget. And in particular, I'm going to talk about the contents of the government's business tax roadmap, which was released as part of the budget documentation. So let's start with some budget basics, which is on my first slide. And as you can see there, this was George Osborne's 8th budget. We had the budget on the 16th of March, and then the draft finance bill was released a week later on the 24th. It's been described as the Chancellor's first revenue-neutral budget, but of course there's always a very mixed bag in these kind of things. And we've certainly seen some tax cuts for small businesses, entrepreneurs and higher-rate taxpayers through the personal allowance. But that's predominantly been funded by increases in taxes for multinational companies. And we've seen a number of fairly major announcements in this budget. The finance bill itself is 571 pages, and the Red Book, which contains the details that are released on the day of the budget itself, was 145 pages. It's a fairly significant document. And of course, as I mentioned before, we have the new business tax roadmap. So let's go straight into looking at what was in the roadmap. So in terms of what the roadmap is, it sets out the government's plans for businesses essentially for the remaining life of this government for the next 5 years and beyond to a certain extent. And the aim is to give businesses certainty they need to plan ahead and to make long-term investments. The roadmap itself focuses on 3 main areas and is divided into 3 main parts. The first one is described as continuing to reduce tax rates and drive growth. The second is described as tackling tax avoidance and aggressive tax planning. And the final area is to do with simplifying and modernising the tax regime. So let's look at the first one of those key focus areas, which is to do with continuing to reduce tax rates and drive growth. So let's focus by looking at corporation tax. So the rate is currently 20%. And if you think back to just as far back as 2010, it was 28%. So we've already seen an 8% reduction, literally in the space of 6 years. We know from the summer budget that the rate was going to go down to 19% from the 1st of April 2017, and then to 18% from the 1st of April 2020. And it's this latter rate, the 18%, is now going to reduce to 17% from the 1st of April 2020. This will give us the lowest corporate income tax rate in both the G7 and the G20. Our rate will be the lowest at 17%, and the next rate up, if you like, from that will be Russia at 20%. And then there's a bit of a gap until you get to territories like Germany, 30%, France, 33%. Japan has a rate of 30%, and of course the US is a complete outlier, approximately 40%, including federal tax and state taxes. Now, summer budget 2015 previously announced that very large companies will accelerate the timing on their payment of tax, their equivalent of QIPs, if you like, quarterly instalments. That new regime is going to come in from the 1st of April 2017. That's now been delayed by 2 years and will come into effect on the 1st of April 2017. Now, although most of the contents of the roadmap is concerned with large companies, it's not limited just to large multinational groups. So the following elements, if you like, affect both individuals and entrepreneurs. So we've seen the capital gains tax rate reduced from the current 20% from 28% to 20% for higher rate taxpayers, and 18% to 10% for basic rate taxpayers. That won't extend to residential property. We've seen what was described as an extension to entrepreneurs' relief to cover external investors in unlimited or unlisted companies. But that actually is a new rate, a new lifetime allowance, a separate £10 million that is available to investors who are not employees or office holders in unlisted companies. There are requirements that the shares must be held for 3 years, although there is no minimum shareholding that's imposed by the rules, and will apply to newly issued shares on or after the 17th of March. And business rates, which received a lot of press before the budget, have been for small companies, have now been the small business rate relief has now been extended to 100% from 50% from the 1st of April 2017, and certainly the thresholds for tapering this small business rate relief has been extended to 15,000. The second area of the business tax roadmap is all to do with tackling avoidance and aggressive tax planning. And this really picks up on the work the OECD have been doing through their base erosion and profit shifting project. Now, the base erosion and profit shifting, the BEPS project, was it started in 2012 through the work of the G20. Then it was picked up by the OECD itself and also at the level of the EU. And the programme is divided into 15 separate action points. All of those action points now have the support of the OECD, of all 62 members of the OECD. And if we move on to the next slide. So the OECD, they released their final recommendations on the 5th of October last year, 2015. I've made a caveat there to say, of course, they're not final, predominantly because some of the areas are still being worked on, and some of the areas need further guidance or explanation. But just in terms of what BEPS was looking at, it was divided into 3 main areas: coherence, substance, and transparency. And each of the action points fell within one of those three silos, if you like. Moving on to my next slide to pick up what was covered in the business tax roadmap. So that predominantly looked at 4 of the action points. There was action point 2, which is concerned with hybrid financing arrangements. Action 4, which is to do with the deductibility of corporate interest expenses. Action 5, which is defined as harmful tax practices, although from our perspective we'll be focusing on the UK patent box regime. And Action 6, which is to do with preventing treaty abuse, and in particular using treaties in an artificial manner to reduce taxes, and predominantly, so far as the business tax roadmap is concerned, to do with withholding taxes. So I'm turning the page to look at the first of these areas, so Action Point 2, hybrid financing. And in terms of what it's concerned with, well, it's concerned with the structuring of financing between group companies to achieve predominantly a double deduction of the same interest expense in 2 different territories, or a deduction for interest expense in one territory without a corresponding pickup of the interest income in another territory. Now, we already had draft legislation on this, and it was released for the first time in December 2014, and this year's budget, as did the autumn statement last year, confirmed that legislation will be introduced from the 1st of January 2017, so in just over 6 months' time, to either deny a UK deduction, known as the primary response, or to bring an amount within the charge to tax, that's known as the secondary response. And which one of those applies will be dependent on which situation you're looking at. Now, this year's budget did have an extension of those rules, so the rules previously did not include UK permanent establishments. They will now apply to UK permanent establishments. And it also introduced a targeted anti-avoidance rule where the main purpose, or one of the main purposes, is to secure a tax advantage through the arrangements which a company has been entered into. Now that TAR, the targeted anti-avoidance rule, is not applicable where the arrangements that have been entered into are consistent with the structures or the types of planning that the OECD is still saying they're happy with, and that was contained within the 5th of October report on Action 2. Now, Action 4 was to do with deductibility of interest expenses and to place a cap on the amount of interest that can be tax deducted in each territory. I'm not going to talk about that because my colleague Anton Hume is going to talk about that later in the presentation. Action 5, which the OECD paper is to do with harmful tax practices, and that will have most of an impact from our point of view for the UK patent box regime. And just by way of a quick reminder, so patent box regime in the UK was first introduced in April 2013. It provides an effective 10% corporation tax rate on profits derived from patents. And although it required the UK company to hold a UK or an EU patent, there was no requirement that the development work that led to the patent is undertaken in the territory in which is claiming the benefits from the patent box regime. And so oftentimes you'd see groups owning patents in the UK, but the R&D function would be held offshore, perhaps in places like India or other low wage or low cost jurisdictions. Now, the view that came from the OECD was that the UK regime, and certainly similar regimes that operated elsewhere, encouraged the artificial shifting of profits to territories which had IP regimes. So effectively shifted the income from the developed patent to the UK, whereas the R&D work and the development work was not being done in the UK. And moving on to my next page, so what was introduced in Action 5 and what was contained in this year's budget, in this year's finance bill, was to introduce the concept of a modified nexus approach, which basically says the company claiming the benefits must undertake significant activities that led to the creation of the asset. And in terms of what significant activities means, the OECD linked that to the actual R&D spend on the patent development, and said that must be undertaken by the company that owns the patent. Now, the reason it's called modified nexus is because essentially it doesn't only require the company owning the patent to have undertaken its own R&D, and it does allow a certain amount of outsourcing or subcontracting. So if you look at the numerator of my formula, it takes D, meaning the company's own spend, it's spent in-house, and adds on to that amounts subcontracted to third parties. Times that by a fraction of 1.3 and divides that by the total spend that's been incurred by the company in bringing the asset into existence. Now, this is quite a complicated formula, and what I will just say today is that companies that outsource R&D work to related parties or purchase patents or other intellectual property which has already been developed will be negatively impacted by this formula. And to the extent more work is outsourced in that way, the less the company can benefit from their existing patent box regime. Now, this applies to new IP that was created after the 1st of July 2016, but there are fairly extensive grandfathering rules in the draft legislation that can extend companies that are currently within the existing rules to extend that to 2021. Action 6 is concerned with the use of double tax treaties, and predominantly for our purposes today it's focused on withholding taxes. Now, in the UK, withholding taxes on royalties were already levied for copyright royalties and for patent royalties, and they can be and still can be reduced or eliminated by double tax treaty. But what's contained in the business roadmap and legislation included in this year's finance bill is to extend the scope of what withholding tax can be applied to. Previously, it didn't extend to payments made for the use of other intangible assets, for example, trademarks and brand names. And from the date the finance bill receives royal assent, withholding tax will be extended to those kind of payments. Again, subject to double tax treaties, specifically eliminating from the charge payments made for trademarks and brand names. And secondly, a new domestic and treaty anti-avoidance rule will be introduced to prevent the use of conduit arrangements. Those rules will be brought into effect on or after the 17th of March 2016. The final section of the business tax roadmap is defined as simplifying and modernising the tax regime. And there's at least one welcome change here in terms of how brought forward or carried forward losses, as they're referred to in the roadmap, can be used in the future. And this will introduce a much more flexible use of brought forward losses. Currently, losses, if they can't be used in year, can only be carried forward within the company, and then against profits of the same type within the company. And for losses arising on or after the 1st of April 2017, to the extent they can't be used in year, they can be carried forward and then can be used against other types of income within the company, and can also be group relieved in subsequent years to other group companies. It's very much a welcome change. A less welcome change, certainly for larger companies, for companies that have been incurring significant losses in the past, is a restriction on the amount of taxable profits that can be used or offset by brought forward losses. And for profits in excess of 5 million, there'll be a 50% restriction on that excess that can be covered by brought forward losses. As I say, those rules will come into effect from the 1st of April 2017. So that was kind of a bit of a whistle-stop tour through what's contained in the business tax roadmap and in this year's finance bill. Let me just make some concluding statements. Definitely, as you can see from what's going on here, the tax landscape is changing. We've seen a number of changes that will bring into effect the work the OECD has been doing from the BEPS project. In terms of action point 6, to do with royalties, we see changes there from the 17th of March this year, or from the date the finance bill receives royal assent. The same for patent box, as action point 5, changes there from the 1st of July 2016. Those actions to do with interest, action 2, changes will be introduced from the 1st of January 2017, and for interest deductibility, action 4, from the 1st of April 2017. A more welcome change is a more flexible use of brought forward losses that will come into effect from the 1st of April 2017. So I would advise you to review structures to see how you're going to be impacted by the changes. If you'd like to discuss any of the things we've been talking about today, you can speak to me. My number is 0207 893 3224. And now I'm going to hand over to Anton, who is going to talk about action point 4 and the deductibility of corporate interest expenses.
Thank you, Howard. Howard's discussed the business tax roadmap, and in particular the BEPS actions that have been addressed in that. Specifically, he's addressed action 2 and the effect that it will have on hybrid financing arrangements, and also action 4, which will affect the deductibility of corporate interest expense. I'm here today to talk about the impact of the proposals to restrict interest deductibility, and specifically to let you know a little bit more about our understanding of how the UK intend to implement the OECD recommendations on interest limitation going forward. So what is the issue? What is the concern? The concern expressed by tax authorities in the context of the OECD initiative on this particular issue is that, in effect, there are multinational groups out there that can deduct more by way of interest expense than they pay to third parties. And in the context of the UK's examination of this issue, the UK has concluded that in the vast majority of cases, groups will have a net interest to EBITDA of 10%, and indeed a net interest expense to EBITDA of 30% would be considered to be at the high end of what one would expect to see in third-party situations, and a level at which many tax authorities would cap interest expense. It's described the issue in its tax roadmap as follows, that Some multinational groups borrow more in the UK than they need for their UK activities, for example, because the funds are used for activities in other countries which are not taxed in the UK. But the tax deduction on the interest is offset against UK profits. Groups might also enter into arrangements to claim further tax relief in the other country as well as the UK, which creates competitive distortions. So we now have a proposal from the OECD that has been put forward to address this with particular steps that need to be taken in order to assess deductibility. But before I get to that point, let me just illustrate the issue in this slide, where you can see that Company A has borrowed £100 million from a third-party bank, on which it's paying interest at 5 million, fully deductible in Company A, assuming that Company A is resident in the UK. Company A then injects that £100 million by way of equity in its subsidiary Company B. It receives dividends, but of course under the tax laws of country A, in this case the UK, that dividend may not be liable to tax. Company B then lends on that £100 million to Company C in a third country, on which it receives interest of £5 million, with, of course, a deduction being available in Company C, and Company B taxing that interest, but possibly taxing that interest at a very low rate. So we get a deduction in Company A for the interest it pays to the bank, a deduction in Company C, and potentially quite a low liability in Company B on the interest it receives. So that's the abuse that is perceived to be taking place, and essentially it is to do with, it arises because of the fungibility of funds within international groups. So what the OECD have recommended in action point 4 of BEPS is a best practice approach to limiting interest deductibility in these circumstances. And let me start off by saying that we're talking about interest on debt that is not necessarily just related party debt. This applies to interest on all debt, whether related party or non-related party. The recommendations are set out in some simple steps, which I've tried to encapsulate on this slide. First of all, one applies a de minimis monetary threshold to remove low-risk entities, because, of course, the OECD and tax authorities are concerned about picking up the more significant perceived abuses in this instance. So they're proposing that for interest below a certain threshold, that will not be subject to this prospective new interest limitation rule. Subsequent to that, the proposal is to introduce a fixed ratio rule. A fixed ratio rule by which an entity can deduct net interest expense up to a particular ratio, that ratio being established as a net interest to tax EBITDA ratio. The OECD has suggested a corridor of 10 to 30%, which may be permissible, and it is up to particular jurisdictions to establish where it wants to fall within that corridor in the adoption of the rules in its particular territory. Now, subject to that fixed ratio rule applying a restriction on interest deductibility, the OECD suggests that a group ratio rule may be introduced in jurisdictions so as to accommodate those entities that may have external interest, bank interest, at a level which would exceed the total group, would exceeds, the fixed ratio rule cap that is applied, but by reference to the total group. So what it is saying here is that an entity might deduct total net interest expense, external net interest expense, up to the group's net interest to EBITDA ratio, where this is higher than the fixed ratio. So let's say that the group's external net interest to EBITDA ratio is 40%, then it is in fact that ratio that is then the cap and for the particular group, subgroup or entity to which it applies and overrides the fixed ratio rule. The OECD then suggests that rules should be introduced to address volatility. So in circumstances where a particular company may have disallowed interest, then it might be allowed to carry forward that disallowed interest to use against capacity in a future year. Or indeed it may have unused interest capacity that it can then carry back or carry forward to offset against disallowed interest. That's an optional rule which it is left to particular jurisdictions to introduce depending on what they think is appropriate. The OECD then recommends that there should be an exclusion from these particular rules for projects that benefit the public. In this context, that's perceived to, for instance, to include infrastructure projects, so perhaps roads, hospitals, and the construction thereof, and also the development of energy capacity. The OECD is suggesting there might be targeted rules over and above these rules that support general limitation rules and address specific risks, and are suggesting that there should be special rules to address particular issues pertinent to the banking and insurance sectors, which would take them out of this particular set of recommendations. So what's been the UK response to this so far? The UK has suggested that it will introduce a de minimis monetary threshold of £2 million. So in effect, after the application of any specific anti-avoidance rules to restrict interest, if the total interest expense of the entity, or if it applies at a group level, the group is less than £2 million, that it won't have any further restriction by virtue of the application of these proposed interest deductibility rules. Indeed, if interest exceeds that figure, then that £2 million, I suspect, subject to further consultation, is going to be deductible anyway. So we have a guaranteed £2 million of interest that will be deductible before any application of this test. With regard to the fixed ratio rule, the UK has been rather generous in suggesting that it will apply a net interest to EBITDA ratio up to 30%, which is very good news. The UK is also going to apply a group ratio rule, which again is generous. This was potentially optional under the OECD recommendations. The UK is going to be drawing up rules to address volatility, but we don't have any details on that as yet. The UK will be introducing an exemption for certain public interest projects, but we have no details on that either. And with regard to general rules to support interest limitation, the UK has made it clear that it wishes to replace the worldwide debt cap to decrease the already existing complexity of this potential rule on top of the complexity of the existing worldwide debt cap, so that we have a further restriction broadly mirroring the existing worldwide debt cap rules based on total group debt, but we have no interest on that, no details on that particular issue as yet either. With regard to banking and insurance sectors, the UK is continuing to engage with the OECD. So the UK have made some good progress in establishing at a very high level how it will apply these prospective interest deductibility rules, but there is a huge amount of further detail to address, with more questions than answers right now. For instance, the mechanics of the group ratio rule are a little unclear. In particular, it's uncertain as to whether shareholder interest may be treated as being external interest for the application of the group ratio test, as it is for the worldwide debt cap, or not. How the public benefit project exemption will be defined is unclear. We have no rules to address or no guidance as to what any rules to deal with volatility in earnings and interest may look like, or whether we'll see any special rules to put in that might apply for joint ventures, and indeed any rules to address what it is feared many groups might seek to achieve to deal with splitting of groups. Other operational factors as well have yet to be addressed, and in particular the implications for foreign exchange and whether foreign exchange movements will be brought within these new rules or will not be. We're expecting a view to be taken on most of these issues following a second round of consultation, which is expected shortly. So let's just address the group ratio rule for a bit. What is that going to look like? The group ratio rule will allow interest relief where net interest expense and debt is in line with the group's overall position, to allow some flexibility to highly externally leveraged groups, so that the fixed ratio rule doesn't apply a restriction on interest deductibility that goes so far as to disallow interest even on external debt. That's the intention of the rule. The group ratio will be calculated by reference to group accounts. It will look at group external net interest to group EBITDA. A group is defined in line with accounting standards and would exclude portfolio holdings and joint ventures, etc. There is an alternative option for carve-out. It seems unlikely that the UK will apply any alternative option to the group ratio rule as it's set out in the OECD recommendations. But it is likely that the UK will subject the application of this rule to an overall debt cap of 100% of total external group interest. So I think what we can say with regard to the group ratio, though, is that it won't necessarily, of course, allow a deduction for all interest expense, as debt is not spread evenly around the group in exact proportion to earnings. And although the group ratio rule is likely to accommodate volatility if you carry forward disallowed interest or unused capacity, or it's the carryback of disallowed interest, this will not address this particular problem fully, and therefore groups should be taking action to ensure that they don't get caught in this particular trap. So let's illustrate how the group ratio rule will apply to facilitate a deduction which is greater than that which would be available if the fixed interest ratio test were only to apply. In this instance, we've got a parent company that has borrowed 150 million of bank debt with an interest charge in a particular year of 7.25 million. It has lent 100 million to its UK subsidiary, on which its UK subsidiary pays 5 million of interest, and it's lent 50 million to a non-UK subsidiary, which is paying interest at 2.5 million. The non-UK subsidiary has non-UK EBITDA of 8 million. The UK subsidiary has UK EBITDA of 15 million, with therefore total worldwide EBITDA of 23 million if we're assuming that these are the only entities within the group. So if we look at the UK fixed interest ratio of 30%, on 15 million of UK EBITDA, we get a restriction of the UK interest of 5 million to 4.5 million only, so a limitation in deduction of £500,000. Applying the group ratio test in this context with worldwide EBITDA of 23 million and a worldwide net interest expense of 7.25 million, that would imply a group external net interest ratio to worldwide EBITDA of 31.5%. We then apply that higher ratio to the UK. The UK EBITDA of 50 million at 31.5% gives a total deduction for interest of 4.75 million in this context out of the 5 million. So in fact the restriction here is 0.25 million only. So we get another £250,000 worth of interest deduction by virtue of the application of the group ratio test over and above that which would be available by the application of the fixed ratio test only. So let's turn now to ThinkCap, because there'll be many people out there that will be thinking that the UK's provisions dealing with ThinkCap, under which the quantum of any particular related party debt may be restricted by reference to the arm's length principle. Many people will be thinking that the UK ThinkCap provisions have died. By no means have they. The UK ThinkCap provisions are applied in priority to the application of the new interest deductibility rules, and therefore we still need to worry about them. Whether, of course, groups will have the appetite to seek advanced ThinkCap agreements to the extent that they have historically in the context of the new rule is another issue. But we've still got a whole panoply of anti-avoidance provisions like the UK ThinkCap provisions to worry about, even subsequent to the introduction of this new interest deductibility provision, which is likely to happen from the 1st of April 2017. So a little bit of crystal ball gazing. First of all, the changes to interest deductibility rules are likely to be potentially costly. There are very many areas of existing uncertainty. Although grandfathering rules have been referenced in the OECD recommendations, it doesn't seem likely that the UK will apply them, but we'll have to wait and see for the second consultation to get further insight into that. Of course, the OECD recommendations are designed to promote consistency in the way in which jurisdictions deal with interest deductibility. But because the corridor for the application of the fixed ratio rule and other optional aspects of the recommendations are so wide in the first instance in relation to the corridor, or optional in the second instance, we're bound to see continuing international inconsistency in the way in which interest deductibility is going to be treated from one jurisdiction to another, which of course then increases which of course means that we remain in a situation where we have uncertainty with regard not just the application of rules, but where and in what circumstances double taxation may arise, which I think it inevitably will. There will be a particular impact on certain sectors. Of course, the property sector is likely to be impacted very significantly in the context of us seeing particularly high levels of leverage in relation to that particular sector. REITs is a sector which, and the rules applying to REITs is an area which is likely to need further clarification, because the application of these rules will just make the operation of the REITs rules impossible without further amendment. And we're still waiting to hear more about how public interest projects are defined and to what extent companies operating with that space will be able to fall outside of the application of the proposed new rules. So what should you be doing now? First of all, I would suggest an impact review, and the sooner the better. So take a look at the nature of your debt, shareholder versus third-party debt, form of the debt, your existing rulings or advanced cap agreements in place. Look at how the application of the new rules may apply both in the UK and globally, and then consider what you might be doing to restructure your debt to ensure that the impact of the proposed new rules is minimized as far as possible. Finally, we're just about to embark on a new round of public consultation on the application of the rules in the UK. Do share your concerns with us. We'll be actively involved in that debate, and we'll be keeping you up to date with regard to developments. Thank you for your attention.
I'm going to walk through the new legislative requirement for large businesses to publish their tax strategy. This was introduced in the autumn budget, with revised draft legislation and accompanying guidelines being published in late March. It forms part of a wider suite of measures aimed at enhancing large corporate compliance. HMRC have explained that whilst they believe that their existing strategy of working with large businesses is working for the majority, they feel the need to reinforce the message to a small number of large businesses who they believe still represent a significant risk to the exchequer. The measures include a framework for cooperative compliance, which outlines the behaviours HMRC expect to see large businesses demonstrating, and is a watered-down version of the voluntary code of practice which was originally proposed, and a special measures regime which introduces increased reporting requirements and limitations on certain reliefs and clearances for those businesses which HMRC see as persistently engaging in aggressive tax planning, or who refuse to engage with HMRC in an open and collaborative manner. So who does this legislation apply to? Well, there are thresholds of £200 million turnover or £2 billion assets. Those of you familiar with senior accounting officer legislation will recognise these as being the same thresholds. As for SAO legislation, any UK company meeting the threshold in its own right will be caught. And like SAO, the thresholds are applied to the accumulated turnover assets of the UK group. Also, like SAO, UK companies associated through overseas parents will also need to have turnover and assets accumulated in considering the threshold. Unlike SAO, however, permanent establishments of foreign and relevant bodies will be caught by the tax strategy legislation. So if either alone or with other UK group entities they exceed the thresholds, PEs will be caught. And also, unlike SAO, partnerships under these three definitions exceeding the thresholds will also be caught. So that covers who is caught by the turnover assets threshold. But there are another tranche of businesses caught by this legislation, and these are all UK companies within a multinational enterprise group where the group has a reporting requirement under country-by-country reporting, or who would do if the head company were in the UK. So that's any UK company within an MNE group with global turnover exceeding €750 million. This means that even the smallest UK-based companies will be caught if they fall within such a group. Now, we queried this with HMRC, partly because it doesn't seem to fit with their impact assessment for this legislation, which indicated that around 2,000 businesses will be caught. Now, that number sits firmly in the SAO population arena, and we believe that there will be many more companies than this actually caught as a result of this MNE provision. HMRC have, however, confirmed that this is the correct interpretation of the legislation. These companies will be caught. There is, however, some hard lobbying going on at this point and pressure for HMRC to introduce a de minimis, so we will wait to see what will happen with that. And what do HMRC mean by tax strategy? They're looking for a high-level strategic document which sets out the overriding tax objectives of the business aligned with their commercial strategy. The published document need only refer to the tax affairs relevant to the UK tax, and HMRC are clear that they expect this to be more than just a one-off statement, and they want to see that it is embedded into the business and supported by a framework of processes and controls and an active, rich risk management framework. HMRC are clear that businesses can include as much information as they wish within the strategy, but there are 4 areas which are prescribed in the legislation as being required. The guidelines for the legislation suggest what maybe should be covered in each section, and the bullet points on the next few slides summarise what this says. The first required area is a description of the business approach to tax risk management and governance. Essentially here, businesses need to be talking about the framework they have in place to ensure that they are paying the right tax at the right time. Some consideration does need to be given to the content here. For example, in answering how the business identifies and mitigates risk, you may want to refer to the Keeping the Tax Risk Register. However, HMRC could and probably will request sight of any documents referred to in the strategy, so the business would need to be happy with their position on this. The second area which must be covered is the business's attitude to tax planning. Important in drafting this section is consideration of the language to be used. HMRC commissioned a report last year looking at tax strategies, and from this have aligned certain language with high and low risk behaviours. For example, references to acting within the law indicate to HMRC higher risk attitude, whereas acting in the spirit of the law demonstrates lower risk. The third area to be covered is a description of the level of risk that the group is prepared to accept. This is a very subjective area and will probably be the most challenging area for a business to articulate. We would recommend, however, that businesses do try and come up with more than a bland statement in respect of this requirement, as again the report commissioned noticed that such statements are designed to give businesses maximum flexibility, and HMRC are therefore likely to read this as indicating a higher risk behaviour. The final area required legislatively is a description of the business's approach to dealing with HMRC. Clearly, what HMRC are looking for are references to open and transparent collaborative working, but this does then have to be backed up in reality. Okay, so what is the actual publishing requirement? The strategy needs to be published annually on the company's website. It must be published by the last day of the financial year to which it relates, but not less than 9 months or more than 15 months after the day on which the previous year's strategy was published. It can be a separate document or a self-contained part of a wider document, but it must be available free of charge for 12 months or until the following year's strategy is published. And although not legislatively required, the guidance does state that HMRC expect businesses to inform their CRM where and when the strategy has been published. In terms of when the legislation comes into effect, the first period for which a business will need to publish their tax strategy is the first period which commences after the day on which Royal Assent of the Finance Act is passed. And for most businesses, this will be their 2017 year end. There are penalties for non-compliance. If a business either fails to publish a strategy in line with requirements or fails to make that tax strategy available for the prescribed period, an initial penalty of £7,500 will be levied after a 30-day warning period, with a further £7,500 payable if the situation has not been rectified after 6 months, and then £7,500 additional penalty for each month of non-compliance thereafter. But the risk is not just financial. HMRC are mandating that the CRM should assess businesses' response to this legislation as part of their business risk ratings reviews. So non-compliance, but also the actual content and wording within the document, could result in a non-low risk score being awarded. So how do you develop a tax strategy? We see there as being 4 key stages. First of all, you need to articulate what the priorities of the business are from a tax objective. And this would typically involve getting together the key stakeholders in a room to thrash out what these are. Preferably in the presence of a third party who's able to objectively challenge how realistic the objectives are. Once identified, the strategy then needs to be documented, of course in accordance with the legislation, and should be approved formally by the board. The next stage is probably the most difficult, being the need to embed the tax strategy in the business. This requires an evaluation of the existing underlying framework of policies, processes and controls, with subsequent gap analysis and implementation of any additional needs required to support the strategy. And finally, the strategy needs to be reviewed annually and updated as necessary. I'm going to pass over this slide as it just refers to the report commissioned by HMRC, which I've largely mentioned already. Okay, so whilst I'm sure many businesses will be viewing this new legislative requirement as an onerous addition to their to-do list, actually if done correctly, there are many benefits to formulating a tax strategy. I met with one tax manager recently who can't wait to have to comply with this legislation. He works in a large, overseas-owned business where there is currently no real interest in tax at board level and hence throughout the business. And he can see that having a clear mandate from senior management, which will be monitored by HMRC, will help drive tax to become better understood throughout the business and will make his job much easier. And having an articulated strategy also then provides a foundation on which the systems and controls can be put in place to ensure that tax risk can be managed. We worked with one business who had carried out a large transaction with significant tax impact, and the first the company's tax department knew about it was when they read about it in the newspaper. They came to us for help to stop this happening again, and we started by putting in place a tax strategy and then embedding controls which, amongst other things, ensured that all transactions of a certain nature or size were directed to the tax department before actually going ahead. And of course, this document is also useful for discussions with HMRC and to help drive a low HMRC risk rating where demonstrably embedded in the business. So actually all of these benefits would lead me to ask those businesses which are not caught by the legislation to consider whether they should go down this route in any case. Finally, for businesses who already have a documented tax strategy, a few things to consider, which I will not read through but may help in determining the level of update required. Key to remember is that the tax landscape has changed significantly in recent years, and in particular, the wording used in the document should be considered. If a current tax strategy does not contain the word transparency in it somewhere, it probably needs to be revisited. Thank you. That's what I have to say on tax strategy today. I hope that's been helpful. If you have any questions, of course, you can direct them to either myself or your normal BDO advisor.
In late 2015, our VAT team undertook research to understand and assess the profile of VAT across the UK today. We surveyed individuals who had direct responsibility for VAT in their organisation on a variety of VAT-related topics. The survey included a wide selection of organisations in a variety of different industries and includes businesses with turnover below 10 million to businesses with turnover in excess of 500 million. The purpose of the research was to establish how much importance VAT was given across industry and whether there are any points businesses may wish to address in order to mitigate risk or increase VAT efficiencies. Following slides outline some of our key findings. We asked businesses what VAT complexities they faced in their organisations. Perhaps unsurprisingly, partial exemption was the most complex challenge faced by organisations, but this was closely followed with 131 respondents saying that large number of transactions and invoices cause particular complexities. And only 20 respondents responded saying that there were no complexities faced by their organisation. We asked organisations who prepares the VAT returns. 36% of organisations responded, saying that the VAT returns were prepared by assistants or clericals. Slightly less than that, 35% of organisations responded by saying that the finance director or financial controller prepared the VAT returns. However, only 18% of returns were prepared by VAT managers. Perhaps unsurprisingly, the larger the company, the more likely they are to have a VAT expert in the business. In companies with a turnover in excess of 500 million, 43% have a VAT manager to prepare the VAT return. Only the very smallest and the very largest businesses account for the 9 organisations which outsource their VAT returns. We then asked organisations who reviews the VAT returns prior to submission. 79% of those that responded said that there was an internal reviewer that reviewed the VAT return. Only 17% said that there was no reviewer, and 4% used an external reviewer. When analysing the responses further, we found that only 10 of 118 businesses with over 100 million turnover have no reviewer, and this extends to 17% for the total population of organisations reviewed, which is a clear contrast to the often expensive corporation tax process. Having gained some insight into the preparation and the review process of organisations, we asked what VAT training or experience the reviewer preparer of VAT returns have. The vast majority of those with responsibility for VAT do not have formal VAT training, with little difference between the smallest and the largest businesses. Attendance at seminars was cited as a key external source of knowledge. We asked organisations if they have had a recent VAT inspection. 57% have had a recent VAT inspection. This is consistent regardless of the size or industry of the business, showing no particular trend. Finally, we asked organisations if the penalty regime affected their approach to VAT. Around 2/3 of companies said the penalty regime made no difference to their approach to VAT. 13% of respondents were not aware of the penalty regime. Our research identified many interesting themes, issues and challenges, and highlights the diverse way VAT is managed. Main consistent factor is the overwhelming recognition of the high level of complexity. This is significant when coupled with the vast sums of VAT collected in the UK. 19.2% of the government's total expected revenue for the financial year 16-17 compared with 6% for corporation tax. This suggests that VAT should be given significant focus, but is it? Our findings perhaps suggest otherwise. Only 9% of those responsible for VAT are CTA qualified. CTA representing the only potentially relevant qualification for VAT practitioners. 48% of respondents have no VAT team, but only 5% have no tax team. And 17% of respondents indicated that VAT returns are submitted to HMRC having only been reviewed by the preparer, which in some cases may be alarming, where those preparing returns have little, no formal or informal VAT training. It may therefore be that some organisations could give more consideration and time to VAT, and this may in many cases bring benefits to companies. For example, efficiency reductions in VAT costs, as well as mitigate the risks. We would encourage you to consider your organisation's position and whether you are comfortable that your business is maximising its VAT efficiencies and managing VAT effectively.
Hello everyone, my name is Malcolm Joy. For the next few minutes we're just going to take a quick look at some of the potential tax implications of Brexit, obviously a very topical issue at the moment. Before we look at some of the tax implications of the UK leaving the EU, we'll just start by reminding ourselves of what might happen if the UK decides to stay within the EU. And within the international tax landscape, one of the main themes that has been around the last year or two is the initiative on base erosion and profit shifting that the OECD has been looking at, commissioned by the G20. And these BEPS measures launched 2 years ago, and final report coming out in October of 2015. They've been very enthusiastically adopted by the UK, but it's very clear that the EU is even more enthusiastic than the UK has been around a lot of these measures. And I think one thing that we may expect if the UK stays within the EU is a very rapid pace of adoption of the various BEPS measures. And this could lead on to a few other interesting developments if we stay within the EU. One of the ways that the EU has looked at eliminating base erosion and profit shifting within the EU is to have a common tax base, what's known as common consolidated corporate tax base for all companies within the EU. So every company would have to calculate its profits in the same way, irrespective of which state it's based in. Now, this is an idea that the EU looked at a few years ago, but I think with the whole BEPS initiative, it's something that's come back on the agenda. And there are some thoughts around that if we stay in the EU, then this may be something that gets looked at in more detail again. And if this is implemented, then what would happen is that the member states would only have the right to set the corporation tax rate rather than the right to alter or affect which profits are within or without the corporation tax system in the first place. So some potentially interesting things would be happening, changing anyway, even if we were to stay in the EU. But if we decide to move out of the EU, there's some upsides and some downsides. And next couple of slides, we just looked at some of the possible pros and cons of this, starting off with the negative sides first of all. And I think one of the biggest one is the uncertainty that it would create in the tax system. A lot of multinational businesses, when choosing where to locate and looking at how they operate, one of the things they prize more than anything else is having certainty over their tax position. What they don't want is uncertain positions rumbling on that they don't know how to account for in their published accounts. And undoubtedly, because there would be a period of change, leaving the EU would create more uncertainty for any company that's based in the EU. Secondly, we would have some obvious issues around customs duty. The EU is primarily a zone where we can buy and sell without having to worry about customs duty. Now, as a lot of people have been talking about in the media and speculating about at the moment, if we were to leave the EU, it is likely that we would agree some kind of deal with the EU so that we would stay within some kind of free trade agreement. However, what that doesn't resolve is the fact that actually the EU itself has signed a further 34 different free trade agreements with other parts of the world. And it would not, well, it's not obvious that if we were to leave the EU, even if we were to come within some kind of free trade zone with the rest of the EU, whether we'd still have access to those free trade agreements that the EU has signed with other places. I think another area of a downside is the uncertainty around the VAT system. VAT is a tax that was introduced as a result of our membership of the EU, and all of the, well, a lot of the precedents, the rulings, the cases, the case law that we have on VAT is decided at an EU level. So if we move outside of the EU, even if we are to retain the VAT system, and I think it's very likely that we would retain a VAT system, it's not clear that the precedents we have over deciding how that VAT system should be interpreted would remain as they are. Moving on now to withholding taxes on dividends, interest and royalties. Payments within the EU are usually free of withholding tax on dividends, interest and royalties. Now that may be because there is just no withholding tax domestically, or it may be because they are protected by a double tax treaty, or it may be because they are protected by the interest and royalty directive or other directives within the EU that prevent withholding tax arising on intra-community payments. Now, if we were to leave the EU, the added layer of protection that is provided by the EU directives will fall away. And it's only likely to be a limited number of circumstances, but there could be some instances where interest, royalty or dividend payments within the EU would now be subject to withholding tax. And then finally, in terms of the downside of leaving the EU, the final point we've got on here is the specific relief that's in the UK legislation for cross-border merger activity. This is a relief that, although it's incorporated in the in the UK legislation, it's referable to membership of the EU. So membership of the EU is a condition for this to apply. If we want to leave the EU, then some of those cross-border mergers which have been taking place on a tax-free basis in recent years will not be able to benefit from that relief going forward. Looking now at the upside of leaving the EU from a tax perspective, I think one of the things that we would be able to do is we would have greater flexibility over the tax system. There are a number of tax reliefs which the UK has, which are contained or limited by membership of the EU. Now, a couple of examples I'll throw in here. One is research and development tax credits for small and medium-sized enterprises. That counts as state aid, and under EU law, companies can only benefit from one type of notified state aid for a particular activity. So if a company is carrying on research and development that's able to benefit from those small and medium-sized tax credits, but is also eligible for types of grants income that also qualify as state aid, then it has to choose which of those two benefits it takes. It cannot take both. Whereas if we remove ourselves from the EU, then there would be greater flexibility on those benefits. There would also be more flexibility on other incentives that are at the moment restricted by the level of by our EU membership. And an example that springs to mind is the Enterprise Investment Scheme, which is limited in terms of the value of the benefits that can be taken by our membership of the EU. VAT is another area that could change. I mentioned on the previous slide that VAT is likely to stay, but our VAT rates and the different reliefs and exemptions that exist in the VAT system are very much controlled by membership of the EU. So if we were to leave the EU but retain a VAT system, then there is the possibility that we could introduce lower rates of VAT for areas that we want to incentivize spend on. And this could give us a lot more flexibility in terms of encouraging different areas. And then the final one I've mentioned there is new tax incentives. I mentioned earlier on that there are existing tax incentives that could be made more generous, or the restrictions around them could be relaxed if we were outside the EU. But clearly there is also the possibility for introducing a much wider range of tax incentives in areas where we currently aren't able to because of our membership of the EU. So that was just a very quick canter through the potential tax implications of staying in or leaving the EU.
So that brings us to the end of our webinar, and thanks to all of our speakers. If you have any questions, please do get in touch with your usual BDO contact or email, taxmarketing@bdo.co.uk. If you found this webinar helpful, I would certainly suggest attending our next On Top of Tax seminar, where the material is even more powerful live. If you would like to ensure that you receive an invitation to this, as well as all other relevant material that BDO produces, please also email taxmarketing@bdo.co.uk. But for now, I shall say goodbye and thank you for listening.